following radio program is for informational purposes only and is neither specific nor tailored financial advice to any individual. It is not intended as an offer or solicitation for the purchase or sale of any financial instrument. Always do your own due diligence and consult a financial advisor before making any investments. Investing involves risk, which can result in the loss of any or all principal. Peter Weitz is a registered investment advisor with Fusion Analytics Investment Partners, LLC, an SEC-registered investment advisor, as well as a registered rep with Fusion Analytics Securities, LLC, a FINRA-registered broker-dealer and SIPC member. All views expressed in this program are those of the host or guests and do not reflect the opinions of Fusion Analytics Investment Partners nor its affiliates. Your investments. How secure are you that they are secure? Do you want to know more about investing, retirement, and moving to the next level in business? Welcome to In Black and Weitz, featuring host Peter Weitz. Our program will answer all of the questions about your future and so much more. It's all about smart business and smarter investing. Now, here is your host, Peter Weitz.
Hey, good morning. Welcome back to the program. I'm your host, Peter Weitz. Before we get into today's program, I want to thank last week's guest. We did get some nice response on what's been a transformation in the hiring process, and I really enjoyed that program. This week, we're going to be a little more political. We're going to get a little more on the edge, and I'm joined by a very special guest. I'm going to introduce him in just a moment. Make sure if you have any phone calls, you dial into the show. You can certainly email me at peter@inblackandweitz.com. I'll also be tweeting some of the important comments that our guest makes on Twitter. You can find my handle at Peter Weitz. But let me introduce today's guest, Tony Hobbs-Boiardi. Tony Boiardi, he's a partner at Camtraco Management Services, which is a commodity company serving as a partner for crude oil acquisition and distribution. And before I tell you a little bit more about him, he's going to speak specifically today about the crude sector in the commodity world, and sort of we're going to get into a little bit about how the global impact of what goes on in wars could potentially affect the crude industry. But I'm actually going to have him break down really what the crude industry means in just a moment. But prior to being at Camtraco, he was the U.S.-based commodities trading manager for a company called Soltex, which it was an Omani-owned oil services company. Prior to that in his career, he's been the founder of a company called Quantum Advanced Technologies, which is an engineering company that designs and develops new patents in modulation and encryption techniques and technologies. He also was a financial manager for Safeway and for Christian Salvesen, which is a shipping corporation and a food distributor based in the UK. He's a qualified associated chartered management accountant and a commodities financial analyst, and I'd love to welcome Tony Boiardi to this morning's program. Good morning, Tony.
Hey, Peter. That was a great introduction. Thank you very much. My ego is bigger than it should be right now.
Well, you've earned it. So, I guess the first question I have, I mentioned in your intro that, you're heavily involved in the crude oil, I'm going to call it brokering of crude oil. But, when we as individual investors and we look at the stock market charts and Bloomberg and Yahoo Finance and so on, and we see a oil price per barrel, that isn't necessarily related to specific crude. There's a whole different definition to that. And I'm wondering if you could just start out by giving me an overview and giving our listeners an overview of really when you take a barrel of oil or you take oil out of the earth, what happens? What is it?
Well, the crude oil in itself is basically just a geological, formation of hydrocarbons that's been compressed over billions of years from just, waste matter. And what all we've basically done is being able to drill down and tap into those hydrocarbons, which are, in different geological formations. Across the globe. And of course, the reality is that there are different rock formations or different sand formations or water formations all across the globe. And depending on the various depths and the densities that there are within, each continent, each country that has found crude oil has found a different quantity or different quality of crude oils. And, the different quantity, we've all been used to sort of the the Middle East as being the major oil-producing areas of the world. And, of course, everybody knows of Louisiana and Texas as the American basins for our crude oil. And, of course, Venezuela has it. But, each one of those different countries has a different quality of oil. So there is no such thing as just a basic standard crude oil. Crude oil has different consistency, different gravities. One is much thicker, one is much more sour, one has more sulfur in it, one has less sulfur in it. Different crude blends or different crudes are used for different things. We make jet fuel to fly our planes, we make gasoline to drive our cars, we make diesel fuel to power diesel fuel power stations. And, then we have residual fuel oil, which is the second and the third cuts after the refining. And we go down into getting liquid natural gas, and we go down into getting different chemicals. And then we're left with residual oil, which basically is the bitumen, which we use as tarmacadam basically to pave our roads with and actually make our building construction materials out of. So there's nothing in oil that we actually waste. But depending on, where that oil comes from, certain oils are better than others for making certain particular fuels and certain particular items that we then sell in a residual market. And that's what in the oil industry they refer to as the spread. So, you will have a price of crude oil depending on whether that oil comes from a WTI source here in the United States, such as Texas or Louisiana, light sweet crude, as opposed to 40s blend, which is Norwegian, or Brent, which is all of the colder North Sea oil, or whether you're talking about African light sweet oil. They all have different consistencies, and they all have different properties, and they will all be good for something. One blend will be particularly better than another at developing something else, and because of that, they're priced differently. The yield of a barrel of oil is going to change depending on what that particular oil is. So, a market is derived out of, obviously, the refiner buying in what is a feedstock of their choice, and depending on the market that they're in and the time of the year, they will actually decide what feed they're going to use and what product they're going to make, what is in demand, such as some are driving to make more gasoline or vacations or more traveling with airplanes, and therefore they're going to need to make more jet fuel or more gasoline. Just because of the demand goes up, and therefore they will choose a different type of crude to actually make that. The different cuts at a certain time of the year will depend on different geopolitical consequences or different geopolitical situations across the world, different political events that are happening, embargoes such, and then refiners will have to tailor where they're getting their crude from. And that therefore, that then shows, that the fluctuation in price on what is a daily basis. So the market doesn't just sell futures based on the crude oil. They will also basically sell futures on spot prices and futures prices based on every single product that you can make on different markets, from the NYMEX commodities exchange all the way through to petroleum futures, to diesel futures, to residual fuel oils, to heating oils, to all kinds of, to naphthene products. And this is all sold in advance, and therefore we create an entire market out of every single product that we have. So, different traders are basically working in certain areas, and different traders are working in other areas. And that just is, a kind of brief summary of, how complex the oil market basically is. But what my particular role is actually looking to acquire the basic raw crude that can then be sold on to those different refineries for actually them to create those different products with.
Understand. And you've touched on a lot of topics we're going to get into, but I guess my first generic question in that regard, and you mentioned the Middle East, and we'll talk about that later in the program, but in my world and in the financial markets world, we try to use as much information as we can to make the best educated price decisions for investment as we can. But it seems to me that your industry is more subject to geopolitical risk than potentially any other.
Oh, well,
And
yes. I mean, you know, there are a couple of things happening which everybody's aware of right now. I mean, you know, we're fighting in Syria. We've been fighting in Iraq. We've been fighting in Afghanistan. Our entire political infrastructure has been set up around oil for the last 30 years. You know, I'm still of the age where I remember, it seems like yesterday, when President Bush #1 took us to war in Iraq, and that was based over the invasion of Kuwait. We never really came out because, you know, less than 15 years later, we're actually going back to the Gulf War for a second time. You know, and the entire Middle Eastern policy of the United States has been based on ruling in that essence, or gaining a hegemony in the Middle East to secure reasonable crude oil supplies, going all the way back to 1957. 1956 and 1957, when Great Britain, Israel, and France invaded the Suez Canal to make sure that they got their crude oil supplies, and America basically kicked the British and the French out of Suez, and then this, you know, had this favorable position in the Middle East. So America's foreign policy has been very much dictated by acquiring open markets for crude oil. You know, it's very important, and that brings us all the way back to today about, you know, the information that you were saying that people require to make logistical decisions based on whether or not the price of oil is going to go up or the price of oil is going down, and so they can make their decision based one way or the other. And, you know, it's a very, very difficult business, and you know, industries are born out of that. And you know, the information that investors get is very contradictory on a day-by-day basis. It's, you know, not every news channel gets it correct, and not every news channel really understands what's going on. And this goes to, you know, people that I read daily, you know, from the Wall Street Journal and from Forbes. I mean, just a current example of today. I was reading an article last night from the Wall Street Journal that was discussing about why crude oil prices are depressed right now, and the ongoing sluggishness of the Chinese housing market and the Chinese building industry, and why that was dragging the rest of us down. And that came out yesterday in the Wall Street Journal. Well, immediately I closed that article. I open up my oil report for the end of business last night and the opening of business today, and smack bang, article #1 on my Platts Oilgram is the announcement that China is now the same market that the Wall Street Journal had said earlier on the day was now bringing everybody down. A few hours later, for opening news today, they turn around and say China is now picking up its oil consumption on month. It's now up 4% than it was last year, and it's now beginning to open up, and the demand for crude oil in the Chinese market is now beginning to really take off. So between the oil industry and between the Wall Street Journal, you have two conflicting stories. So somebody who's now going to bet on the future market of what crude oil is going to do over the next 6 months is going to be sitting there scratching their head, just based on two independent reports that come out.
Yeah, and that's you know, that's sort of what my thought was, and I suppose that I would probably rely more on the industry report than potentially the report that is put out by the Wall Street Journal. And Tony, I want to talk about that in just a minute. We're going to take a quick break. We're going to be back in just a couple minutes. Back with Tony Boiardi on the In Black and Weitz radio program. Talk to you in just a few.
When it comes to business, you'll find the experts here. Voice America Business Network.
ERISA 408B2, fiduciary standards, safe harbor, fidelity bonds, record keepers, discrimination testing. I am so confused.
Does your 401k plan have more questions than answers? Peter Weitz and his team of 401k experts have a solution. Their on-site service model distinguishes them from other service providers, and they are specialists in 401k costs, regulations, and compliance. If your 401k plan has more questions than answers, then contact Peter at 877-945-2888 or email him at peter@inblackandweitz.com.
Climbing Mount Everest is an amazing feat, and many have died trying to do so. However, more people have died descending Mount Everest than in reaching the summit. Part of the problem may be that people are so focused on reaching their objective that they fail to plan appropriately for what they will do or should be prepared for afterward. Similarly, people are so focused on saving for retirement and reaching retirement that they fail to plan appropriately for what they will encounter once they have actually retired. With 1 out of every 4 65-year-olds today living past the age of 90, you may be retired longer than you are actually working. Have you devised a plan, process, and discipline to ensure that you will not run out of money? If you are not sure what to do, then simply contact Peter Weitz and his retirement team at Fusion Analytics. We help manage human emotions using 3 proprietary investment techniques. Our job is to evaluate the forces that the typical investor can't see so that wealth is preserved and not lost. Find out more at inblackandweitz.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandweitz.com. In Black and Weitz, we win by not losing.
When it comes to business, you'll find the experts here. Voice America Business Network.
You are listening to In Black and Weitz. To reach Peter Weitz or his guest today, please call 1-866-472-5790. That's 1-866-472-5790. You may also send an email to peter@inblackandweitz.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandweitz.com. Now, back to this week's program.
Hi, thanks. Welcome back to the program. I'm your host, Peter Weitz. We are joined by crude and commodity expert Tony Boiardi, and we're speaking about the amazing industry known as crude and what's going on in the world and how it impacts us here in the States. And prior to the break, Tony was talking a little bit about how the geopolitical forces really impact what goes on in the world of crude pricing, and there's such a big conflict between who thinks the price is going to go in what direction, and really who do you rely on to make your decisions as to when's the right time to buy or when's the right time to sell. And Tony, it made me think of a couple of years ago that fuel prices were really starting to spike. And in the airline industry, Southwest Airlines was able to keep their fares lower because they had hedged their fuel positioned for at least a couple years going forward. And, I'm wondering what gave them that foresight then to think differently than the rest of the airlines and sort of what's happening today.
Well, it was a long call that Southwest Airlines made all those years ago about betting on the price of oil going up. I mean, it really didn't take a rocket scientist at that particular time, seeing the way that the industry was going. I mean, we were talking about year in, year out, particular, prices going up. Basically Southwest put a hedging collar on their futures prices of jet fuel. So while jet fuel was going up from $40 to $100 a barrel, they were paying an insurance policy based on having a fixed budget, knowing that they would rather pay $55 a barrel for their oil or for their jet fuel rather than let it just sink and float in the market to what maybe be lower or what may be higher. They actually just decided we will take the average and we will take the insurance policy out on there, and they just won out. Basically, they just put a hedging insurance policy on their future prices, and they were able to stabilize the average price of their fuel for a number of years, which the other airlines weren't able to do. What is more interesting, not the fact that they did it, is the fact that nobody is doing it today. When the recent airlines were all analyzed about their hedging futures, depending on the different markets, there are only few airlines in Europe that are doing it. None of the American airlines, none of the airline companies in the United States right now or Southeast Asia are hedging against the volatility of jet fuel prices in the world right now. And maybe it's because they're seeing what they believe to be a downward trend, because with all of the different political things that are happening, we're tending to have a pretty stable oil price. And we really aren't seeing a great deal of explosiveness anymore in the jet fuel industry, pardon the pun, but we're just not seeing that volatility at the moment. And rather than spend the extra money on hedging the price going up, the airlines have been very, very beaten up over the last couple of years. So that extra money that they're saving by not hedging is actually going directly to their bottom line right now. And a lot of those airlines can't be blamed for taking some extra profit when it's available on the table now that oil prices are pretty stable. But the difficulty is that we are one political event right now from oil prices going back up to $120 a barrel and jet fuel going back up to $130 a barrel. And that is going to obviously come down to the consumer. I mean, just look at last week. We just look at the Labor Day weekend. It was not really widely reported to American consumers, but they started to limit the amount of jet fuel that the airlines could actually use at JFK and Miami International Airport and Chicago. People were flying in and the airlines were running out of fuel. There was such a shortage on the East Coast, and there was, because of different reasons, the refineries weren't making enough jet fuel at the time. Our imports of jet fuel had been reduced for different reasons. And then all of a sudden we're coming to a weekend where everybody's traveling and there's not enough jet fuel. So, the airlines got stuck at that particular weekend either having to pay much, much more at the spot prices to actually fill up their planes, or they were having the airport authorities actually restrict the amount of flying hours that those particular planes could fly by limiting the amount of jet fuel that they had. And that impacts the bottom line at that particular time. And, all the airlines are paying more or flying less, which means their revenues are going down. That didn't happen several years ago when Southwest decided to hedge theirs because they were guaranteed their supplies, they were guaranteed their pricing. Not today. People are just not taking that risk anymore, or they're just deciding to go without the collar this time.
Yeah, and that's amazing. I must change gears on you, Tony, for just a couple minutes. But, as mentioned in the beginning of the show, there's some unrest in the Middle East. And, again, we're involved going back in, and we could argue that this is really, have we come out, or is this really our third time since 1993? But what effects? I mean, we rely on the Middle East, Iraq and the UAE and OPEC for oil. I mean, what impact does this have on us here in the United States fighting the Middle East when we're actually asking them for oil?
Well, the thing that we've got to remember as consumers, first of all, is that I have a very, very strong view on the Middle East, and not just the Middle East, but I have a strong view on what we're doing with our domestic policies right now for crude oil. But from the Middle Eastern perspective, I truly believe that even though American consumers are getting sick and tired of seeing American troops or allied troops go and try and secure what is a political hotbed in the Middle East, that is worthwhile for our long-term strategy. At the end of the day, we still do not have another energy source on this planet quite like carbon crude oil. And the problem is, in this world, we can use the adage that he who has the last drop wins. It is a zero-sum game. It's very simple. We do not have an alternative source of energy. We like to think that we can use solar, we like to use wind, we can do this, water, energy this from this and energy from that, but we can't. 95% of all of our energy sources is coming from crude oil, and therefore it becomes very strategically important that we secure those reserves. The problem is that we should be importing more oil from the Middle East. We should be importing more oil from Africa. We should be importing more oil from every area in the world that we can get our crude oil from, rather than cannibalize what we have here in the United States. Because at the end of the day, if we run out of crude oil in the United States, we are solely at the mercy of the other oil-producing nations, and that is what is the problem right now. As you said, we are going back potentially for a third time because of the Islamic State fundamentalists. And the Islamic State fundamentalists kind of grew up over the last couple of years, and they've caused all of this problem originally because of what was going on in Syria. But, when they're fighting to overthrow Syria, Syria is the country that we've put an oil embargo on. And the Syrians are being funded, and the Syrians are in allies with Iran, and Iran we have an oil embargo with. And, we've just spent a decade at war with Iraq, and we've just come out of Iraq, and the Iraqis are building up their infrastructure based on oil reserves, and, we don't necessarily want to be seen to be the aggressor in the area. So our whole Middle Eastern policy is very much fundamentally dictated by how we are seen by basically our geopolitical adversaries, which is the Russian economy. The Russians, for the last however many years, have actually, which most people don't realize, have been the largest oil-producing nations in the world, and they have been flooding the market with their crude oil, and we've been buying a lot of it. So there have been many alternatives that we can go to without going necessarily back to the Gulf and getting it. But the problem is that we need to be using that oil. We don't need to be using ours. Crude oil from anywhere else is the best crude oil in the world right now. And, people will say, Peter, about, we don't want to be spending $200 billion worth of crude oil or money, American dollars, on foreign countries' crude oil. Think of the balance of payments. Think of their trade deficit. Think of all of these other things. And I'm thinking to myself, if you're worried about the trade deficit, then, we spend more than $200 billion on cheap Chinese TVs and DVDs and not so much VCRs anymore, but on cheap Chinese stuff that we're bringing into the economy. And, that doesn't have the ramifications of the balance of payment deficit that we think about, like crude oil does. So we're prepared to send armies overseas to secure those reserves for us, and still use our crude oil here in the United States and burn up our crude oil reserves, which we shouldn't be doing. But if we're worried about, the balance of payments, let's just invest in American economies and develop American infrastructure and build American goods, and then still use foreign oil to do it at the same time. Because, we're in a never-ending cycle of basically, some political people said, in the last couple of elections, we've got to drill all the oil that we can out of the United States of America. Keep on drilling. Well, the problem with keep on drilling is we keep on burning, and we keep on burning it. We keep on developing our economy. Our economy keeps on growing. Our economy overheats. It gets larger. It has a more insatiable appetite for more oil. The more insatiable appetite for oil, we're using more American oil, and then all of a sudden, it's gone. So we've grown our economy over the next however many years using American domestic product, and guess what? We're going to have to go back to the Middle East. Whether or not we're going back now is irrespective to fight, Islamic militants. It's irrespective. At some point, we're going to have to go back, because if we allow the markets to dictate who they're going to sell the crude oil to, let's face facts, we're not liked very well in the Middle East. So OPEC has, over a history of years, embargoed the United States of America, and that's why we've had our Middle Eastern policy the way it's been. So at some point, whether it's now, tomorrow, next week, next month, next year, 5 years, or 10 years' time, we're going to have to secure more reserves. And that means we're going to have to go back at some point, because people are going to remember what we did and how we reacted and what our political position was to fundamental Islam, to the Muslim communities, to our policies with Israel, to our policies with Palestine. They're going to remember that when we've run out of crude oil. And that's the fearful thing that we should be thinking about, is not how cheap we can make oil right now by drilling our own stuff, but the future consequences of actually going back into the Middle East in the future and paying exorbitant prices for it. Because we're not just America, we'll be competing against India. We'll be competing against China like we're doing right now. And when you think that, I remember when I first came to the United States, and I first moved here as an adult, oil prices were down $20 a barrel and gasoline was at 90 cents a barrel. Well, the Chinese economy wasn't coming online at that point. So, the days of cheap oil are over just because the expansion of India and the expansion of China, we're in competition with those people. We're in competition with those nations. So supplying us as a nation with our crude oil has to be done in only two ways: foreign imports or American. And if we're going to use American crude oil first, we're going to pay the price for it in the future. So going back to the Middle East right now, it might not be something that people want to see us do. It might not be something that people say, well, we've been there for 10 years, we've got to get out. Well, you know what? We don't have to get out. We have got to make that part of the world sensitive to what we need. We have to stabilize it, we have to keep it stable, and we have to make it friendly, finally. And the problem with that is we've got different political views with different particular countries. We have different views on working with the Assad government. We have different views of working with Iran. We have had sanctions against the Iranian government now going on 5 years. We've tried to cripple their crude oil for one reason. We've tried to cripple their crude oil production because we've been frightened that they will obviously get a nuclear weapon. That's what the fear is. The fear is that they are expanding into nuclear technology, and at one point they're going to have a nuclear weapon, and if they get a nuclear weapon in the Middle East, then all of a sudden America's geopolitical future strategy of being able to control the Middle East has gone completely out of the window, because the big man on campus is no longer going to be America. It is going to be Iran. And the problem with that is it's true. And, the Iranians are very, very sophisticated as a country. I mean, they have some of the finest engineers, the finest mathematicians. They have some of the finest universities in the world. They've got unlimited amounts of government resources to develop what they need to develop. And it is only an inevitability that at some point in the near future, they are going to develop their own nuclear technology, which, by the way, according to the UN legislation, is not illegal. Everybody has the right, unless they've signed up for the Non-Proliferation Treaty, they have the right to nuclear fuels.
And
at
Tony,
one point, it's going to happen.
Yeah, and that's an interesting point. I got to take a quick break. When we come back, I'm going to pepper you with a couple of other questions that I don't think you know are coming yet. We're going to do that in just a minute. You're listening to the In Black and Weitz radio program on Voice America Business.
From the boardroom to you, Voice America Business Network.
Climbing Mount Everest is an amazing feat, and many have died trying to do so. However, more people have died descending Mount Everest than in reaching the summit. Part of the problem may be that people are so focused on reaching their objective that they fail to plan appropriately for what they will do or should be prepared for afterward. Similarly, people are so focused on saving for retirement and reaching retirement that they fail to plan appropriately for what they will encounter once they have actually retired. With 1 out of every 4 65-year-olds today living past the age of 90, you may be retired longer than you are actually working. Have you devised a plan, process, and discipline to ensure that you will not run out of money? If you are not sure what to do, then simply contact Peter Weitz and his retirement team at Fusion Analytics. We help manage human emotions using 3 proprietary investment techniques. Our job is to evaluate the forces that the typical investor can't see so that wealth is preserved and not lost. Find out more at inblackandweitz.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandweitz.com. In Black and Weitz, we win by not losing.
ERISA 408B2, fiduciary standards, safe harbor, fidelity bonds, record keepers, discrimination testing. I am so confused.
Does your 401k plan have more questions than answers? Peter Weitz and his team of 401k experts have a solution. Their on-site service model distinguishes them from other service providers, and they are specialists in 401k costs, regulations, and compliance. If your 401k plan has more questions than answers, then contact Peter at 877-945-2888 or email him at peter at inblackandweitz.com.
Voice America Business Network, the bottom line in business.
You are listening to In Black and Weitz. To reach Peter Weitz or his guest today, please call 1-866-472-5790. That's 1-866-472-5790. You may also send an email to peter@inblackandweitz.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandweitz.com. Now, back to this week's program.
Hi, thanks. Welcome back to the program. I'm your host, Peter Weitz. I'm joined today by crude and commodity expert Tony Boiardi, and we've been spending most of the time talking about, the impact of crude on many different facets of what's going on in the world. And, Tony, I was seeing yesterday that the U.S. government was sued, and please correct me if my data is wrong, but, from what I understand, 95% of all fuel or all crude in the United States is transferred by rail. And I understand that the U.S. government was sued because it's not necessarily safe to transfer it all by rail. And I understand there's been several explosions in different cities throughout the year, and I'm sure the environmentalists are having a meltdown. But what's your take on that?
Well, I mean, it's absolutely true. I mean, people forget because we have a 5-minute attention span sometimes that a couple of years ago, an entire railroad system collapsed, going through going through Quebec, and it blew up. It was carrying, the highly volatile, fracked crude oil, through Quebec, and it blew up. I mean, it blew up, it destroyed the entire city, and 47 people were killed through that, and there have been several explosions, coming through American towns and American cities right here on our doorstep. The biggest problem is that, as you were saying, the Department of Transportation just got sued a couple of days ago. What they're doing is they're allowing this crude oil to be transported on old-fashioned style transport rail cars, what they're called DOT 111s. The DOT 111s are normally regulated for carrying vertical drilled oil, the solid crude oil that we have. The problem is that what we have right now is that, people keep on referring to the fracking, hydraulic fracking technology. Well, the problem with hydraulic fracking technology is that they are drilling oil out of the ground in what's called horizontal technology fashion. So instead of drilling down, they drill through a rock formation. And when they drill through a rock formation, they are getting crude oil out of a rock that is creating what is pushback from the gases that is actually trapped within the rock itself. So if they actually drill into a rock formation that has no gas, they don't want that oil. What they want, because they can't get it out, they can't suck it out. So what happens is they drill into a rock that has lots of gas in it. The gas forces the oil back out, which they're able to then take out of the ground. The problem is that oil that we're taking out of the ground has got lots of gas in it. So when you actually put that oil, or what is basically a light condensate, very gaseous oil, into a sealed tanker and transport it, it's very volatile. Have you ever, when you run your car empty at a gas station, okay, and you open up the gas tank and you take off the lid of the gas tank, of course, if you're really low, what you tend to hear is this big hiss coming out. That's the gas that is escaped from the petroleum. Well, it does the same thing with this particular gas. So when you have the rail car systems coming through the United States of America, these are like small bombs coming through. And so therefore, because these rail cars are not suitable, the government just got sued. It was the Sierra Club, if I'm not mistaken. Sierra Club and Earth Justice, Forest Ethics, they've been banging on the door of the Department of the Environment for months. And they first filed legal petitions going back to July, where they tried to get in an emergency order just to stop the transport from the Bakken regions of North Dakota and Montana, because, the risk. I mean, it's not too unreasonable to think that if you're going to put this highly explosive crude oil on a rail carrier, that it should be at least a safe rail carrier. And that goes back to the fact that, the infrastructure development within those particular fields, which, again, to get a barrel of this crude oil out of the ground, Peter, which people go, this goes back full circle to our first conversation. So we've got the railroads, which are unsafe to be carrying this stuff, which is causing major security issues. And of course, Warren Buffett owns most of the railroads who are distributing all this stuff, to be quite honest. So why isn't Warren Buffett's companies putting the money into the infrastructure to develop the railroad system to be able to transport the crude oil to the markets where they need to? Well, the problem is we're running out of this so-called crude oil explosion that we're having, or this revolution of crude oil. It's dying already. These are our reserves that we're eating up, but why aren't we building the infrastructure? People are talking about, building infrastructures, but we're not really building it. We're not building an increased infrastructure for the railroads. We're finding it very difficult to get Bakken crude oil to the market. And this is why Bakken crude oil historically has traded at almost $30 historically below WTI international prices, because it's so difficult to get from Wyoming and Utah and Colorado and, all New Mexico, where all the Bakken fields, it's difficult to transport that crude oil to where it needs to go. So they've had to sell it at a discount because the people who are distributing it have added the distribution cost to it. So the problem is the investment companies who have been spending upwards of $200 billion over the last 5 years to actually distribute this crude oil, haven't made a penny. They're not making any money. When you're actually having to pay anywhere between $85 and $115 a barrel to actually get the crude oil out of the ground, to frack it, distribute it, get it to market, and you can only sell it at $90 to $100 a barrel, the question is, they don't want to spend the money on the infrastructure. So this is why a lot of these people are refusing to actually pay the extra money to put the extra safe cars on there when they've got an old infrastructure they think they can get by with for the next however many years without improving the infrastructure. So it becomes very, very important that, that the environmentalists actually do their job, because, given big oil, once again, big oil is not necessarily going to do its job. It's trying to maximize its revenue or reduce its losses while it figures out how it's actually going to carefully market the crude oil that we actually have coming online from the new fracking technologies. But, any company is going to be self-regulating up until the national government or a state government regulates it for it. Right at this moment in time, we've let the oil industry do what they want. We've let the rail industry do what it wants when it comes to distributing this oil. And this is the biggest beef that the Sierra Club and all the Earth for Justice agencies actually have, is that there's not been enough oversight and not enough regulation for new crude oil, which is very, very explosive in nature, to actually be sealed in these old-style tankers that are not suited to carry this particular crude oil.
And that's
the problem that we have.
Right, and that's interesting. And when we get back from the break, Tony, I'm going to ask you about a question that might be somewhat near and dear to your heart. We're going to talk a little bit about what's going on in Scotland. We're going to do that in just a minute. You're listening to the In Black and Weitz radio program on Voice America Business.
Voice America Business Network, the bottom line in business.
ERISA 408B2, fiduciary standards, safe harbor, fidelity bonds, record keepers, discrimination testing. I am so confused.
Does your 401k plan have more questions than answers? Peter Weitz and his team of 401k experts have a solution. Their on-site service model distinguishes them from other service providers, and they are specialists in 401k costs, regulations, and compliance. If your 401k plan has more questions than answers, then contact Peter at 877-945-2888 or email him at peter@inblackandweitz.com.
Climbing Mount Everest is an amazing feat, and many have died trying to do so. However, more people have died descending Mount Everest than in reaching the summit. Part of the problem may be that people are so focused on reaching their objective that they fail to plan appropriately for what they will do or should be prepared for afterward. Similarly, people are so focused on saving for retirement and reaching retirement that they fail to plan appropriately for what they will encounter once they have actually retired. With 1 out of every 4 65-year-olds today living past the age of 90, you may be retired longer than you are actually working. Have you devised a plan, process, and discipline to ensure that you will not run out of money? If you are not sure what to do, then simply contact Peter Weitz and his retirement team at Fusion Analytics. We help manage human emotions using 3 proprietary investment techniques. Our job is to evaluate the forces that the typical investor can't see so that wealth is preserved and not lost. Find out more at inblackandweitz.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandweitz.com. In Black and Weitz, we win by not losing.
The business community's first choice in Internet Talk Radio. Voice America Business Network.
You are listening to In Black and Weitz. To reach Peter Weitz or his guest today, please call 1-866-472-5790. That's 1-866-472-5790. You may also send an email to peter at inblackandweitz.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandweitz.com. Now, back to this week's program.
Hi, welcome back to the program. I'm your host, Peter Weitz. We've been speaking today with Tony Boiardi, a noted crude and commodities expert. And, you know, we've been going on many different circles with regards to what happens in this dynamic industry. But, you know, Tony, it's not actually it's an interesting topic. And I've had several months ago on the program a real estate expert. And, you know, obviously one of the hottest real estate markets in the country is in a small town in Minot, North Dakota. And from what I understand from my hotel contacts and from my real estate experts up there is that hotel occupancy rates run 100%, and there's essentially no vacancy available for houses to buy, and it's simply driven by the exploration of oil up in that portion of North Dakota. Well, what happens if they stop?
Well, that's a very interesting question. You know, it's not just that there's 100% hotel occupancy and that you know, the average rental for a shared occupancy house is like $2,000 a month. And you know, if you want a 2,000 square foot house, you're paying $6,000 a month for it. You know, you're having RV cities just spring up, and you're having tent valleys, you know, spring up because people can't afford the housing there. The problem is, it goes back to what one of the things that we were talking about before is what I would call and what other people call bullseye drilling. Okay, and it goes to the infrastructure. You know, North Dakota has expanded because of the hydraulic fracking and getting access to that particular crude oil. And the engineers have been so precise. It is almost like today we can throw a dart in the dartboard and hit the bullseye. We know exactly where these deposits actually are. So every time we open up an oil field, you have to put the infrastructure in there to actually start drilling. And you know, obviously you have to have the entire infrastructure, and labor obviously is the most important part next to the machinery, because you've obviously got to get people to actually work the machines. And that's what's driven, you know, all of the people going to places like North Dakota. So, you know, all of a sudden you've got an entire, what I would call almost like a circus industry. The circus industry is there to do a temporary job, and it is temporary, and this is the shame of it, because most of these oil fields are going to be exhausted very, very quickly. What happens is with one of the oil fields that's actually producing the fracked oil is that it reduces its propensity to generate crude oil by 30 to 50% after the first year of production. Now, that means that in year 2 and year 3, we are now getting minimal yields out of that particular field. And that means that the average cost per barrel of bringing that crude oil out goes through the roof. And therefore, it's not viable or economically sensible then to keep on drilling in that particular field. So what happens is they stop drilling and they move on to another field. And then they will do that for a couple of years until they exhaust that. And then they will move on to another field. So it's almost like the circus is moving from town to town to town to town. The problem with that is, towns are going to depend on and build up an infrastructure for commercialization of basically not just the housing market or the hotel market or the car rental market or the food market, the movie houses and, everything that goes into a local town when you're getting an oil boom. And very soon, all of those oil towns will just start to disappear. It's just like, when they were building Interstate 40 across the United States of America. Everybody was enjoying the building of those roads. Every single town was enjoying the expansion of Interstate 40 until the entire crew moved away. And then there was nothing left anymore. Interstate 66 just disappeared, or Route 66 disappeared, and all of those towns around it disappeared. And that's what's slowly happening. Even though there is an expanse right now, there is going to be a bust, like always happens. I mean, it always happens in the oil industry. It's a Ponzi scheme almost. I mean, I don't want to. It's some people wouldn't call it a Ponzi scheme, but one of the different analysts I read, I read from a lot of different people, but he actually just to take some of his information. I mean, he literally called it a Ponzi scheme. This whole thing, and that the shale oil gas companies, I mean, they have to spend an increasing amount of money on capital to keep their production from falling. And they're basically swimming in debt. I mean, that's the biggest problem. Companies like Chesapeake, Southwestern, Devon, I mean, they're spending a great deal more money on capital expenditures than they're receiving from cash flow from their operations. And that's the problem. Is because they're not making as much money as what they thought. And people like Occidental are pulling out, because they're spending too much money. You're going to have a bust of the oil shale boom. You're going to have this inevitable bust. So the people around the Bakken and Eagle Ford, while production has increased significantly in those two fields, it really does come at a huge human cost. The 40% reduction per year in those fields is almost 10 times faster than the standard global oil capacity field reduction that we've actually had. And to actually maintain, where it was in 2008, we had less than 500 wells producing. Well, we've got over 6,500 wells producing in those fields right now, and we're expanding, but they're getting empty very quickly. And as I said, what happens is everybody has to move on. So you're creating shanty towns when this whole industry moves on. And then in 10 years' time, when it's all over and done with, we've got this new infrastructure that people are looking at the costs of right now that they should be putting in there, but they're not putting in there. And people will be wondering, scratching their head, well, what happened? That 10 years went really quickly. Now there's no employment in our area. So, people aren't necessarily also looking after the money for the local resources to actually put back into the local towns to actually increase their infrastructure for actually displacing the crude oil that they've actually got under their grounds right now. There's no royalties for the towns. That's one of the issues.
And that's we could probably spend an entire show talking about that, and it's it'll be interesting to see what's going to happen to towns like Minot several years from now. Tony, I can't thank you enough for being on today's program. This is obviously a very important and dynamic topic, and we could have gone in many different directions, and I think we barely scratched the surface on some of the issues that are facing us today as it relates to the crude and in particular the energy sector. But I really appreciate your time, and thank you for being on the program.
No, it's my pleasure. Anytime we can pick up the discussion anytime you want to. Thanks very much.
And for those that like to follow Tony, Tony does tweet very frequently regarding issues related to the crude sector, and his Twitter handle is @AJ-Boiardi, and it's spelled Boiardi. So that's @AJBOIARDI. and you can certainly make sure you follow everything that Tony's talking about. I'm going to continue to follow Tony. Tony's going to continue to supply me information for my blog because it's obviously a dynamic and ever-changing industry. Thanks again, Tony. It's been a great show. You're listening to the In Black and Weitz radio program on Voice America Business. Make it a great week.
Thank you again for tuning in to In Black and Weitz. Please join your host, Peter Weitz, again next Tuesday at 10 a.m. Eastern Time and 7 a.m. Pacific Time for another edition of the program on the Voice America Business Channel. Have a safe week.